Knowing when to buy stocks can be the difference between maximizing returns and buying at the peak of a bubble. While timing the market perfectly is nearly impossible, understanding key patterns and economic signals can help beginners make smarter investment decisions. Whether you're a long-term investor or an active trader, knowing the best times to buy stocks can improve your chances of capitalizing on market trends while minimizing risks. One of the most widely followed strategies for buying stocks is to buy during market dips or corrections. Market downturns provide opportunities to purchase quality stocks at a discount, allowing investors to enter at lower valuations. When markets decline by 10% or more, historically, they have always rebounded over time, making pullbacks an ideal time for long-term investors to accumulate shares. Another key strategy is to buy stocks at the beginning of the year or quarter. Market trends show that stocks often experience a seasonal boost in January, a phenomenon known as the January effect. This occurs as institutional investors and hedge funds reposition portfolios, and individual investors reinvest after year-end tax planning. Similarly, the start of each financial quarter often brings renewed buying interest as companies release earnings reports and set new performance expectations. For traders looking for shorter-term opportunities, the best time to buy stocks during the trading day is typically in the morning and late afternoon, the first hour of trading, 9:30 a.m., 10:30 a.m. EST, tends to experience higher volatility, providing active traders with strong price movement. The last hour before the market closes, 3 p.m. to 4 p.m. EST, is another period where stocks see increased activity, making it a strategic time to enter positions. Another important consideration is buying stocks during earnings season. Earnings reports released quarterly can cause significant price movements. If a company reports strong earnings and positive guidance, its stock price may rise sharply. However, if earnings disappoint, it can create a short-term dip, an opportunity to buy high-quality stocks at a lower price. Economic indicators also play a major role in market timing. Stocks tend to perform well when interest rates are stable or declining, inflation is under control, and economic growth is strong. Watching for signals from the Federal Reserve, GDP growth reports, and inflation data can provide insight into when to buy stocks. If the economy shows signs of slowing but is not in a full-blown recession, it may be an optimal time to buy before a recovery begins. One of the most profitable times to buy stocks historically has been during recessions and bear markets. While market downturns can be intimidating, they often present the best buying opportunities for long-term investors. Stocks of strong companies with solid fundamentals become undervalued, setting the stage for significant gains when the market rebounds. Warren Buffett's famous advice: be fearful when others are greedy, and be greedy when others are fearful, is a reminder that buying during periods of pessimism often leads to the best returns. Market psychology also plays a role in identifying good buying opportunities. When market sentiment is overly bullish, with stock prices reaching new highs and media optimism at its peak, it may be better to wait for a pullback. Conversely, when fear dominates and most investors are selling, contrarian investors see opportunities to buy stocks at bargain prices. Monitoring the Fear and Greed Index, or the VIX Volatility Index, can help gauge investor sentiment. For beginners who don't want to worry about timing the market, dollar cost averaging, DCA, is an excellent strategy. DCA involves investing a fixed amount of money at regular intervals, e.g., weekly or monthly, regardless of price fluctuations. This approach reduces the impact of short-term volatility and ensures that investors accumulate shares over time without making emotional decisions. In addition to economic and market indicators, sector rotation is another factor to consider. Different sectors perform better at different points in the economic cycle. For example, technology and consumer discretionary stocks tend to thrive during economic expansions, while utilities and healthcare stocks perform well during downturns. Understanding sector rotation can help investors determine which industries to focus on at different times. Ultimately, while market timing can enhance returns, it is secondary to investing in quality companies and maintaining a long-term perspective. The stock market has historically trended upward, rewarding patient investors who stay disciplined through bull and bear cycles. While knowing the best times to buy stocks can provide an edge, the most important rule is to start investing early and remain consistent.